So, let's talk about the markets. If you've been watching them lately, you're probably feeling it, right? That little bit of uneasiness. Things just feel shaky. You see a lot of red on the screen, and honestly, it's causing a ton of anxiety for just about everyone.
And hey, if that's you, you are definitely not alone. That feeling, it's everywhere right now. We're hearing it from seasoned traders, we're hearing it from long-term investors. That fear is just palpable in the air. But the big question is, what's really happening here? I mean, beneath all the scary headlines, is this the big one? The start of a massive crash? Or is there something else going on under the surface? Well, that's what we're going to dive into. We're going to break down the data and figure out what's actually driving the market right now. Okay, so first things first, let's just get this out of the way. Your concerns are totally valid. It's not just a feeling. The charts themselves are telling us a story. And yeah, broadly speaking, the market is breaking down. And look, this isn't just one little corner of the market having a bad week. We are seeing a pretty clear pattern of lower highs, and it's happening across the board. We're talking the big guys in the S&P 500, the tech giants in the NASDAQ, and even the smaller companies. It's a pretty synchronized move down. But, and this is where it gets really interesting, despite all that carnage, all that feeling of panic in the air, the S&P 500 is actually only down about 4.7% from its all-time high. So wait a minute, why does it feel so much worse than that? What's going on?
Well, the answer to that puzzle lies in a concept called a rolling correction. And honestly, this is the absolute key to understanding that strange, churning feeling we're all getting from the market right now. So what is a rolling correction? Think of it this way. It is completely different from one of those waterfall crashes. Like we saw back in March 2020, where just everything plummets at the same time. No, this is different. It's more like a relay race of decline. One sector gets hit hard, then it kind of stabilizes, and then it passes the baton to another sector, which starts to fall.
And you can see that rotation happening right here. I mean, just look at this. The very sectors that were the strongest performers all year, we're talking energy, utilities, they're the exact same ones getting hit the hardest this past month. And at the same time, some of the previously weaker areas are holding up better. So, you see, the market isn't just collapsing in on itself, it's churning. Okay, so now that we've got a name for what's happening, let's put all this panic into perspective. Let's look at the history, because this is where we can really start to separate raw emotion from the actual probabilities. And this right here, this is a number you really want to burn into your memory. Look, a correction, which is defined as a drop of 10% or more, it always feels scary, no doubt about it. But what does history tell us? It tells us that 3 out of 4 times, 75% of the time, the market recovers without ever tipping into a full-blown bear market. And we can zoom out even further. Let's look at the data since World War II. The market has gone through 48 of these corrections. Now, how many of those actually spiraled down into a bear market? Just 12. So what does that tell you? It shows that, historically speaking, the odds are pretty heavily in favor of recovery. This chart just illustrates the wild nature of investing so perfectly. Think about this. Even in years where the market finished in the green, the average drop during that year was a whopping 14%. That's huge. It proves that pullbacks aren't just common, they are a totally normal and even expected part of the journey to getting those positive annual returns. Now, check out this number. Over 55% of stocks on the NASDAQ are trading below their 200-day moving average. Now, on the surface, that sounds absolutely terrifying, right? But let's try framing it a different way. If you're an investor, what does that number really mean? It means a whole lot of great, innovative companies are, well, they're on sale right now. Okay, so this all leads to the most important part. What do you actually do about it? How do you navigate this? Well, the right move depends entirely on who you are. Are you a long-term investor or are you a short-term trader? Because the playbook for each is completely 100% different in a market like this. All right, first up, the investor's playbook. For you, this is an opportunity. Your plan is actually pretty simple. First, you target quality. You're looking for those fantastic companies that have just been unfairly beaten down. Second, you buy in percentages. Don't just throw all your money in at once. Start a position and then plan to add more if the price drops further. And third, and maybe most importantly, stay patient. You're hunting for deep, long-term discounts, not trying to time the bottom for a short-term pop. Now, for the trader,
The game is the complete opposite. You are not looking for what's beaten down. You're looking for what's holding up, what's showing relative strength against the rest of the market. And for you, the name of the game is risk management. That means using tight stops to protect your capital. You cut your losses quick, and you trade smaller. In a choppy, unpredictable market like this, you have to reduce your position size to manage that risk. So at the end of the day, corrections and volatility, they're just part of the game. They're unavoidable. They're designed to test our emotions and our discipline. So the real key takeaway here isn't just about market mechanics, it's about our approach. It's about you. Which brings us to the final question I want to leave you with. In a falling market, when you're faced with that sea of red, will you be guided by fear or will you be guided by a plan?